Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, today we've got a special guest joining us, Director of Accounting, Bodie Simpson from Your Future Strategy.
Thank you for having me.
Hello. It's great to have someone else other than just Simon and I joining us. So,
Mix it up.
Look, we're going to get to Bodie in a little while, but I thought, Simon, we might start by just talking about when clients are when people are investing in property and their strategy, they come to the end of their strategy or there's a change in strategy and they're looking to divest in the property. What are the things they need to consider in and around the lending space before they divest in a property?
Yeah, I mean, so assuming that they've got a contract of sale sorted and the property's essentially sold, the first thing to do is to get a discharge authority into the bank. You can either do this yourself, call the bank, or with most lenders that your broker can actually do it as well. And my advice on that is to always get in as early as possible. I don't know why, but banks always seem to scramble last minute, no matter when you put them in, even if it's 2 months before the settlement or something like that. It's always done it, the week before or something. And my other sort of advice on that front as well is don't sort of wait with states with conditions in the contract for those to get fulfilled. Essentially, don't wait for the contract to be unconditional if it's a really tight settlement as well. Just get into the lender. The worst case is that they could actually just cancel the settlement if the sale doesn't go through for whatever reason. You can start it again once you get the sale, another contract and stuff like that. So.
Yeah, that's good advice. I mean, obviously, most people that haven't sold property before don't think about the fact that they've got to actually contact their bank.
Yeah.
They're more interested probably in talking to the real estate agent, getting the number, and then knowing they have to deal with their solicitor or conveyancer in that process, but certainly got to reach out to the bank as well because
I mean, most agents and solicitors are quite good to prompt it, but it's always just keep it in the back of the mind instead of like booking that next holiday with those sale proceeds, so focus on getting it done, so.
Yeah, absolutely. And talk to me about some of the things that can that you need to be wary of, some of the things that might happen. Let's just say, for example, somebody's invested in a property, they've already got an owner-occupied property, but the two properties are with the same lender. Is there any risk or? Yeah,
and we've sort of mentioned this on the other podcast, essentially where you're cross-securitized. So you've got, let's say, one loan and you've got the two houses. And so you're selling one of those properties but leaving one of those properties behind. So the bank will have to do essentially a valuation on the property being left and then do maybe an adjustment on the loan being held or remaining with the lender sort of thing. And this is where complications arise because the bank does the valuation or arranges that. And we all know that valuations tend not to be exactly at market value. They tend to be a bit more conservative on the whole. And that can lead to problems where you're expecting a sale proceed of X, but they've done an adjustment and actually need more of those sale proceeds to balance out that loan sort of thing. And as I was mentioning before, unfortunately, for whatever reason, banks always leave it last minute. It tends to be like the week of settlement or something where these calculations get done. And you can get clients in a bit of a bind because they're expecting sale proceeds a lot higher and it doesn't eventuate sort of thing. And I know we've had clients in the past many years ago where this happened and how we were able to solve it was we were able to give the client some evidence of some comparable sales for the property being left with the bank and to disagree essentially with the bank valuation to increase the remaining security, which then obviously increases the remaining loan that they're happy to do. Fortunately, we were able to get that across the line with that evidence and they were able to just accept it, and that I think saved them something. I think it was like 40,000-50,000 in sale proceeds, so that was a good result.
Absolutely. And probably a good thing to really get the right advice and be organised, because you don't want all that last minute stress on the day before settlement or settlement day, because no one likes the running around at the last minute for this.
No, that's what I mean. Get it in early, and then if you know you might be in that situation with cross-securitized, is maybe flag it a bit early to say, prompt them along, can we get the veil done, or do we need one done, to get those sort of figures finalised a little earlier. That gives you more case to sort of adjust it and argue it as well, sort of thing.
Yeah.
And then I suppose, like I've mentioned before, it's something that, with loan structuring, for the vast majority, we try and avoid that cross-securitization as much as possible, so we don't hit those problems. So once you have one loan with one property, you know exactly where you stand and what your debt levels are and what your sale proceeds are going to be going forward. So, which sort of flows into you, Bodie, what we were talking about before we started, recording and stuff, was talking about what's your intentions of that property before you buy, and making sure you're in the right entity, or having the structure, with loan structure correctly done, so.
Yeah, most definitely. I think particularly around those capital gains tax as well, and what the intention for the property is, like whether it's for you to live in it or for you to rent and invest it out. It's making sure that it's in the correct structure, because if you're on the front foot first and foremost, then you've got a lot more opportunity in terms of the tax planning and resulting in less capital gains when you do eventually decide to divest.
Yeah, I mean, because changing things after the property's purchased, like changing the entity on the title, or changing it from 75 to 25% splits and all that sort of stuff, is really costly with stamp duty and stuff. So it's essentially sort of too late or too costly for most times, to do it.
Most definitely. And you can actually, along with the stamp duty, so if you are transferring an asset, quite often you do attract capital gains tax as well. So you might actually get pinged twice there.
Yeah.
Not only that, you've also got legal costs that are involved with it as well, whether it needs to go through conveyancing, or depending on the structure, you might need a lawyer to look at a company constitution or trust documents. So it can basically end up a very costly exercise if you actually don't sit down and plan out your strategy first.
Yeah. And just coming back, as sort of Trent mentioned earlier, that if we just take a step back, can you maybe go through, let's confirm what a capital gain is for most people, and then how that's sort of the rough tax treatment of it, for the individuals?
Yeah, absolutely. So a capital gain tax is essentially the tax that you've received on funds that have been generated from an asset. So, for example, you purchase an investment property for, we use round numbers, $500,000, and you sell it, say, 2 years later for $1 million. Wouldn't we love that sort of capital gain? But, but you are essentially received a capital gain of $500,000. So the ATO, they want their chip of that, and depending on which structure that you've invested in, you may be eligible for certain capital gains tax discounts depending on how long you've held it. But what you really need to remember is a portion of that capital gain is actually owed to the ATO as a capital gains tax. Now, that's where I guess the structuring becomes really important, because there is opportunity, for example, with CGT discounts being if an individual has held a capital gain an asset for more than 12 months, are actually eligible for a 50% capital gains tax reduction. Yeah. A self-managed super funds, 33.3% reduction. Whereas if you're buying in a company, you don't get any discount whatsoever. There's obviously a lot more structuring around that in terms of your marginal tax rates for individuals, for company tax rates, and those types of things. But it really just shows the importance of making sure that you sit down with a trusted advisor and actually work out what the intention is, what the goal is, and then put in place a strategy to make sure that you're maximizing, your benefit and minimizing the amount of tax payable on that.
And so just thinking out loud there sort of thing. So if you had a property you intend to, the typical, I'm going to buy it, renovate and sell, quickly, maybe it's better to put it in a company sort of structure instead of individual names, just depending on, where your tax brackets are and stuff like that.
Absolutely. That's a great point. And particularly if you're going to be in the investing, the business of, flipping houses. So if you want to basically flip a house a year or flip 2 houses every year, then absolutely a company structure is great, because the profit's taxed at 25%, regardless of whether it's from $0 to 10 million, it's taxed at that one rate. Whereas if you're doing that in an individual's name, then how long's a piece of string in terms of your marginal tax rates? Yeah. As soon as you're up over that 190 threshold, you're essentially paying 47 cents in the dollar, which is a huge take out of the profit that you're taking home.
Yeah.
I don't want to go too far off track here, but obviously if you are renovating and flipping and there's a pattern in that, the ATO certainly recognise and acknowledge that, and then you're starting to move into the space of, are you a professional developer? And then, without going too far down a rabbit hole today, obviously then you're in the GST space.
Exactly. And once you're over, so the GST space sits at about 75,000 or more, which if you're doing your flips correctly, you should be getting more than that. So that's definitely something to consider. And again, shows the importance of making sure that you are working with a tax advisor, you're working with a property strategist, you're working with even lenders. It's these people are doing it day in, day out, and they know what to look out for in terms of like putting in place a foolproof strategy.
Yeah.
And I suppose so step one is really identify what's your intentions with this property is the first step. Like, what are you trying to achieve, here? And then, righto, so which entity is going to be the best, for you tax-wise sort of thing, and go from there.
Yeah, absolutely. I think it's what is not even just putting in place a strategy, what is the goal? So the intention might be to make money, great. Everybody wants to make money, but what's the goal? Is it to redevelop in 2 months' time? Is it you want to basically live on it? Is it a retirement plan? So for example, some people buy on the Gold Coast knowing that it has quite good capital growth. Do they want to move into that? Is that their retirement property? So it's having the goal on what this property is going to do for you. Is it a foot in the door to leverage up to a bigger property? It's making sure that you know why you're purchasing that property. Unfortunately, just making money probably isn't good enough to then work out what the structure needs to be and then work towards minimizing tax.
100%. When I work with clients, we're always starting with the end in mind. So what is your exit strategy? Exactly what we're talking about here is it come down to, exactly what you said. Is it a holiday home? Is it where I want to retire? Is it just purely an investment for creating wealth, knowing that there is an exit strategy? So can't stress it enough that we've got to set the strategy right first. Unfortunately, too many, dare I say it, mum and dad investors shoot from the hip in terms of their investing because they go to a barbecue and they want to keep up with their friends and families of what they're talking about. And they go out and do the wrong thing, but they don't only do the wrong thing. They double down, they do the wrong thing and put it in the wrong structure or the wrong name or the balance of the tax benefits are wrong. And these are costly mistakes in property that some people don't find out until years down the track. And that is lost opportunity, lost time. And really what it comes back to is reverse engineering the strategy, and whether the reality is for most people to achieve what they're looking to achieve in financial freedom and their goals, it probably actually means that they need to do more than one property. So how do you sustainably move forward and do multiple properties where you can do that and execute it from all aspects that we've been talking about? So always comes back to strategy. But getting back to the CGT side of things, let's play out a scenario where, let's keep the numbers easy today. It's $1 million property and you've got hypothetically a married couple where maybe one of the partners is in a higher tax bracket and the other one's in a lower tax bracket. Is there any, and we're talking general advice today, and we're always talking general advice on this. If you want personal advice, we're always happy to talk to you. But general advice, is there something they can do to actually maximize the tax benefits within those ratios?
Most definitely. And I think it's also having a look at, so whether it's going to be negatively geared. So there's two, prongs in terms of this question, being that for a higher marginal tax rate earner, it is more beneficial in terms of having the percentage to them at a higher rate because they are paying more cents in the dollar. So the more we can reduce their taxable income, the greater their tax refund ideally will be. On a capital gain side of things, you do have a risk that because they're at that higher marginal tax rate, they are going to pay tax at a higher marginal tax rate. So I think it's structuring there with, for example, if you've got a higher tax income earner and they're approaching retirement, then the best time to sell that property may be in retirement. Now, what's something else to consider there is whether it's owned by them individually, whether it's owned by a company, or whether we can look to have a self-managed super fund invest in the property. So I think with the structuring on that, rule of thumb is for investment in terms of negative gearing, you are better to have a higher percentage to the higher marginal tax rate earner. But when you sell that, there needs to be consideration about retirement, or for example, what we can do in terms of tax planning. Now, again, I don't want to deviate too much in terms of superannuation, but what deduction can we look at there? Has this high marginal tax rate earner always had a high marginal tax rate, or can we access, say, some bring forward concessional contributions that we can put into super and therefore claim a tax deduction to reduce down that capital gain? So there's benefits there in terms of, I guess, looking to the future and making sure that we can put in place some tax planning strategies to reduce that capital gain. But I think I wouldn't necessarily just buy a property, say, in a lower marginal tax rate earner's capacity, just for the simple fact of paying less capital gains. Because when we look at it, if we've got quite a significant capital gain there, then there's a high likelihood they're going to be pushed into that top marginal tax rate anyway.
Yeah, absolutely. Let's move on to... We're coming up to the end of the financial year for this year. Is there a right time to divest in property from a timing perspective? Is it before the end of the financial year? Is it in the start of a new financial year? And I guess that also depends on where you're at in your journey. If you are approaching retirement, and we are digressing a little bit, but when's the right time to retire? Maybe that's July 1 rather than the end of June or the start of June. So what are your thoughts on that?
I mean, I look at it also from a cash flow perspective. So, for example, I guess if we use a hypothetical, so we're leading up to 30th of June. So I've put a settlement on a contract on my investment property, and it's due to settle after the financial year, but the contract's signed pre-financial year. Now, what can I do to ensure that I can reduce my taxable income as much as possible, therefore paying as least tax as possible? So I'd be looking to my deductions and potentially... Now, I'm certainly not suggesting go and buy things to claim a deduction, because we all know that's definitely not the best course of action. But if there's something that I need in this financial year, I'm better to buy it this financial year rather than in the next to offset my taxable income. So, for example, what we could use as a deduction would be your superannuation that I referred to previously. So I would have a look at what are my untapped concessional contributions over the last 5 years. Do I have the excess cash flow to be able to contribute that into super and then reduce my taxable income and thus my tax on my capital gain? I would also look at, do I need any memberships or insurances, or what can I basically pay for in this year that I will need next year, and I'm not going out and purchasing just for the sake of a deduction, but how can you reduce your taxable income as much as possible in the year that you have the gain? So I guess it's aligning the two, making sure that one, you do need the tax deduction, and two, that the capital gain falls in the year that you're having that tax deduction. Now, I guess all things being considered, retirement is the big one, most definitely. There's also timing of bonuses. So are you expecting a large commission payment? So where you've got income that can, I guess, vary quite significantly, it's the timing on that. So, I mean, next financial year, are you expecting a pay rise? Are you expecting a large bonus or a commission payment? Do you have I guess with real estate agents, a quite considerable property settlement coming in? It's that timing on your income and your expenses and trying to align the two to see if we can get down on marginal tax rates. Something else that's definitely should be considered, and I think is often quite missed, particularly by high income earners, is making sure that you've got an adequate level of private health insurance. Now, depending on what your single income or your family income is, you may actually be up for Medicare levy surcharge if you don't have adequate private health insurance. And in the scheme of things, that's an additional 2.5, or can be up to an additional 2.5% on top of what may be a taxable or a marginal tax rate of 47%. So essentially you are losing 50 cents in every dollar if you actually aren't planning.
Yeah, right.
And just coming back to the timing as well, is like, if I had, a couple of properties and I'm at that stage where, right, I'm going to get rid of them sort of thing. I'm assuming it's better to have one fall in the prior year and then get the other one then in the next one. Don't have them sold in the two years together sort of thing. Is that sort of the general consensus, or?
Definitely. I think because, again, depending on what the capital gains are and the specifics around both of those, it's also important to have a look at if you've held a property and you've negatively geared, say, for the full year, and you sell in that year, you've actually got a negative gearing, I guess, loss per se to apply against that gain. So it would be a lot of structuring in terms of, okay, I've got two properties that I might want to sell and I might want to liquidate quite quickly. What is the level of loss that I have around those two? So if you don't have a loan on one of them, then you're going to look to basically pay a lot more tax if you sell the two properties. Whereas if you've got an investment loan, you're paying quite a high rate of tax, you've got a lot of deductions around those, then it may make sense to sell them at the same time, because you've got basically two sets of losses for those properties to offset the capital gains. So it's just something to consider, I think, in terms of what are your deductions around that property, and what's your negative gearing, because particularly with interest rates fluctuating, they have been relatively high, but I guess quite a while ago they were quite low, and you were seeing that with the shortage in the property market, that there wasn't actually much of a negative gearing loss depending on what the loan value was. And that's where people, I think, run into it. They think, great, I've got a loan, I've got an investment property. But when you see rental properties and I guess the shortage of them, supply and demand, that sort of simple economics, and where the rental properties are starting to skyrocket in terms of rent, and the rent that you're receiving may actually be greater than the deductions that are flowing out, then you're actually paying tax on that as well. So again, something to consider in terms of like the leverage that you do have. I guess it's case by case basis, but something to consider definitely.
Yeah, right. And just clarifying as well, when's the actual capital gain date? Is it the sale contract date, or is it the settlement date as well on the property? Or
it's the contract date.
Okay.
So again, usually depending on if you're straddling financial years, the capital gain is taken into consideration from the contract date. However, obviously you wouldn't lodge your tax return if your settlement date, say a 60-day settlement. So it's just that's a really important factor. And I'm glad you raised that, because I think there's a lot of misunderstanding in terms of which date it actually is. Yeah. And a lot of people are going to get tricked up with that, particularly if they do some tax planning around it and are misaligned in terms of what date actually does matter in terms of your capital gain.
Yeah, and just clarifying as well, obviously that's federal, so
yes.
That's all states.
Yeah.
It doesn't matter where the property sale is, that's the capital gains is, federal tax, so.
Most definitely. And also something, again, with that date is, it's the date on when you've held it to when you've quote unquote sold it. So a lot of these capital gains tax discounts, well, all of them in fact, if you're eligible for a discount, you've had to have that property for more than 12 months. Same with shares or any sort of asset. Mm-hmm. To be eligible for the discount, you have had to hold it for 12 months. So that's something else that I think some people run into. They think, oh great, I'll sell it at this date and I'll have it this date. But unless you know what those dates are, you need to be very concrete, because the ATO will count it day to day to make sure that you are eligible for that discount.
Yeah, and maybe it's a bit complex, but maybe a time for another one. But just quickly, that sort of enters into like that 6-year rule where you may have owned or lived in a property and then rented it out, moved out and rented it out later on, sort of thing, and then sold it, sort of thing. And then there's days calculations. As I said, maybe time for another day, but exactly what you're saying, those day calculations really come into play. So
yeah, absolutely. And I think good record keeping, because the 6-year exemption is incredibly powerful in terms of tax planning and structuring, and obviously it lets people be quite fluid with their movements. Should they want to move overseas, should they want to move states, should they be on an interim contract, whatever it might be, there's a lot of flexibility there, and there's a lot of benefit in making sure that you do have the good record keeping. Now, there's somewhat of a loophole, which maybe I shouldn't say this in case the ATO are listening, but that can be reset as well, which is very powerful for people that do want to travel a lot, do want to move states. So with that exemption is, providing that you don't establish another primary place of residence, i.e. you don't go and buy another property, you can treat your former primary place of residence in that 6-year exemption, and providing you don't have another primary place of residence, you can actually rent that out for up to 6 years. I mean, after that 6 years, you move back into it, that can reset as well. So there can be, again, case by case basis, there's good record keeping needed, but there's a lot of opportunity there for people that do want to move about and don't want to buy another property. There's that option as well, which can save a considerable amount of tax.
Bodie, what I want to talk about is, quite often I get asked with people is, what forms the cost base versus, so how do you calculate the capital gain in terms of tax? Probably not so easy for a non-accounting person to do it, but because it's not a set percentage, which is one thing to consider, but essentially there are a number of different things that form the cost base. So I want to throw to you on that one, but also I want you to cover off, in the case of somebody building, what does that look like?
Perfect. Okay, so a cost base is, there's a whole heap of different things that can contribute to this, but the majority is obviously the purchase price. it will be the legal fees that you've paid in relation to that, any stamp duty, any additional costs. So, when you come through with a settlement statement, there's rates adjustments, those types of things. So that'll contribute to it. If you have had to do any repairs and maintenance, so say, prior to you having tenants or having it available for rent, you've had to replace the carpet, paint the walls, any of those capital deductions can form part of the cost base, because prior to renting it or making it available for rent, you actually can't claim those as a tax deduction. So essentially, they are the main things that would form your cost base. Now, in terms of your sale price, so sale price less cost base is essentially what your capital gain is in a nutshell. That sale price will be what you actually sold for, less what you've paid out to a real estate agent, less any conveyancing costs, because you've got conveyancing costs, obviously, buy and sells, any additional those rates charges, or anything that you've had that wasn't available for rent, but then you've basically had to make it available for sale and then sell it. So there's other adjustments that can go through in terms of depreciation. That's probably getting a little bit more complicated than what we need today. But I think that's where, with capital gains, I would highly recommend that you seek accounting advice, because they can be, quite complicated, and each case by case basis is very different. We've seen quite recently as well that the ATO do go back and review how you calculate your cost base, and with a lot of the data matching. So they know that you've sold a property, they know that you've claimed depreciation. If they're not, ideally, I think they know what their capital gain or the capital gains tax on that property should be. And if they don't see that in the tax return, or they haven't gotten that from your tax, then essentially they're going to either issue an audit or request a further, set of information. So I think where it pays in terms of selling your property is to seek that advice, to make sure that you are dotting your I's, you are crossing your T's, and you don't know what you don't know. I think being in the accounting industry, I probably take it for granted how much I actually do know, but everybody has their expertise in terms of their industry. So I think that's where I'd really recommend actually seeking proper advice and making sure that you are calculating your capital gains accurately.
Yeah, and just 2 points on that I just wanted to pick up on. Was the first one was record keeping. Like when you originally purchased the property, make sure that you've kept the documents about your conveyancer costs and things like that, because as you said, you can't claim them then, but let's say 6 years later down the track when you want to sell it, you have to try and find those. So making sure you have a Google Drive or whatever, you put those on file to make sure and those repair bills and stuff like that to get it ready, that they are ready to go, sort of thing. And the other point I was going to make as well is that I think people forget with tax is that just because you've submitted it and you get your notice of assessment back doesn't mean the ATO's approved it. They've just processed it, sort of thing. They can always come back and later and ask questions like, how did you work that out, sort of thing, so.
Yeah, absolutely. And I think with the ATO, what most people don't know is they think, phew, I've got my refund, or I've paid my small amount of tax payable, I'm good. Yeah. No, the ATO can go back 5 years. And if they suspect that there's been fraudulent activity, or there's been, miscommunication in terms of what your actual income or expenses are, they can actually go back as far as they like. And what happens with that is, yes, they're understanding in terms of there's been a genuine misstatement or misunderstanding, or it hasn't been intentional. But if they believe it's been intentional, they can actually hit you with, one, what the cost should have been or what the tax should have been, and then on top of that, 70% penalties. So I think that's also something that you invest in, making sure that you've, got the right advice around you, because 70% on penalties on a capital gain that's quite significant is a huge whack of, income, and basically it could, and I have seen it bankrupt people, unfortunately, because...
Well, yeah, especially when you said later, this is like later on, just comes out of the blue. You've moved on, you've done X, this could be years later or something.
Money spent.
Exactly.
Yeah, money spent, you've done that holiday and stuff, and then you get the bill, so...
And I think, actually, speaking of money spent, I think what some people forget is that with a capital gain, so for example, if you have a early year settlement, you might sell in January, great, you've got 200K to play with, we'll book a round the world flight, that tax is still payable. And you may have spent that money and not put it aside. And where a lot of people, I think, run into issues with is they actually misunderstand just how much that capital gain can be. It can be in the tens of thousands, even hundreds of thousands. So I think it's making sure that, there's strategicness in terms of when you lodge your return is when your capital gain is payable. And if you lodge through a registered tax agent, you do have an extension from obviously if you're lodging yourself, it's usually about the 31st of October it's due. If you're lodging through a registered tax agent, it's about the 15th of May the next year. So you can basically extend the time frame in which you do have to pay, but you still have to pay. So you're maybe kicking a can down the road. Yeah. I think it's just important to even do a baseline capital gains tax calculation, or reach out to an advisor and they can definitely help you. And obviously you want to be conservative and keeping a couple of $1,000 in terms of making sure that you're putting that money away and it's actually not yours. Yeah. Don't book a round the world trip. Don't go out and buy a new Range Rover. Make sure you pay the ATO first, I think, is big one.
Yeah, look, I think, to summarise, capital gains tax is obviously a necessary part of the journey. And the only reason you're paying capital gains tax is because you've made money out of your investment. And just like in life, there's only two things that are certain: death and taxes. So, it's one that you just need to have, like we said, good record keeping, good advice, good accounting for it. And if you're paying it, you've done well because you've made money. So there's a lot of information there, and that was awesome. Thank you, Bodie. Thank you for your time.
Thanks, Bodie.
So anyone, if anyone, obviously there's a lot of information to absorb there. If you've got any further questions or you need advice, Bodie and the accounting team at Your Future Strategy are here to help. So just reach out. But I think that would be a wrap for today. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.